Elon Musk was just found liable for misleading investors during a $44 billion deal. And it all came down to two words: funding secured. And the market believed him. The stock moved. People bought in. Positions were taken. And some of those people were buying at prices that were never actually justified. I'm Ben Sterling. I advise executive and board level teams on capital structure and economic risk. Follow the capital, because markets don't move on truth first. They move on belief. What actually happened? When Elon Musk said funding was secured, investors interpreted that as the deal is real. The price is supported. There's a floor to this stock. So they bought. Institutions positioned, retail investors followed. But when reality didn't match the narrative, the unwind began. Consequences. If you bought on that signal, you may have bought too high. If you sold early thinking the deal was locked, you may have exited too soon. And when the truth resets the price, someone is left holding the difference. That's not theory. That's how money moves between people. This isn't new. Go back to the railroad boom in the 1800s. Railroads were the most important investment of that era. And figures like Jay Gould and Cornelius Vanderbilt were the center of it. Companies made aggressive claims: new routes, faster expansion, future profits that hadn't materialized yet. Investors piled in because they believed those promises. Stock prices surged, not because of current performance, but because of expected dominance. And when those expectations didn't match reality, railroad stocks collapsed. Entire fortunes were wiped out, not because the railroads weren't valuable, but because the price ran ahead of truth. And we've seen this recently too. Think about SPACs in 2020 to 2021. Companies weren't public based on projections, not profits. Valuations surged. People bought into story. And when the numbers didn't match the expectations, those stocks dropped 70, 80, even 90%. Same pattern. Narrative drives price. Reality corrects it. Someone pays the difference. Regulation. That's why the SEC exists, to make sure investors aren't making decisions based on misleading information. Because when that happens, markets stop being fair. So what does this mean for you? If you're investing, you're not just analyzing companies. You're analyzing narratives, influence, and timing. Because price doesn't reflect truth. It reflects what people believe is true until it doesn't. And when that shift happens, that's where the money is made or lost. Follow the capital.